In this video, we'll be explaining the basics of how the stock market works and how you can invest in it. What is the stock market? The primary goal of the stock market is to help companies raise capital by selling shares to investors, as well as to provide investors with a chance to buy shares in companies they feel will be successful. Investors can also profit by buying shares when they're available for sale at a lower price than when they first entered the market. The most famous stock markets are the New York Stock Exchange and the Nasdaq in the United States. How the stock market works. Publicly traded company stocks may be bought and sold on the stock market. Investors can purchase shares in companies they believe will be successful in order to obtain capital. The value of a company's stock will change based on a variety of factors, such as the company's financial performance and the overall economy. Investors may make a profit by purchasing shares at a lower price and selling them at a higher price. The market performance is often seen as an indicator of the economy's health. Types of stocks. There are several types of stocks that companies can issue, including common stock. This is the most common type of stock and represents ownership in a company. Holders of common stock are entitled to vote on company matters and may receive dividends. Preferred stock. This type of stock does not have voting rights but typically pays a fixed dividend. The dividend is given priority over common stock dividends. Blue chip stocks. These are stocks of well-established, financially sound companies with a history of steady growth. They are considered to be less risky than other types of stocks. Penny stocks. These are stocks of small companies that trade at a low price, usually less than $5 per share. They are considered to be highly speculative and risky investments. Growth stocks. These are stocks of companies that are expected to grow at a faster rate than the overall market. They may not pay dividends, but they offer the potential for capital appreciation. Value stocks. These are stocks of companies that are undervalued by the market and offer good value for the price. They may not have high growth prospects but are expected to generate a steady income. Cyclical stocks. These are stocks of companies whose performance is closely tied to the ups and downs of the economy. Examples include companies in the automotive and construction sectors. Defensive stocks. These are stocks of companies that are less affected by economic downturns. Examples include companies in the utilities and consumer goods sectors. How to invest in the stock market. There are several ways to invest in the stock market, including buying individual stocks. This involves buying shares of a specific company that you believe will perform well. Investing in a mutual fund. This involves pooling money from many investors to buy a diversified portfolio of stocks. A professional fund manager makes investment decisions and manages the fund. Investing in an ETF, exchange-traded fund. This is similar to a mutual fund, but ETFs are traded on stock exchanges, like individual stocks. ETFs also tend to be passively managed. Robo-advisory. This is a digital investment platform that uses algorithms to build and manage a portfolio of stocks, bonds, and other securities on behalf of the investor based on their risk tolerance and goals. Stock options. Stock options are contracts that give the holder the right, but not the obligation, to buy or sell shares of a stock at a specified price on or before a specified date. Risks and rewards of investing in the stock market. Investing in the stock market carries risk, but it also offers the potential for significant returns. Some of the risks and rewards of investing in the stock market include risks. Market risk. The risk that the overall stock market will decrease in value, which can cause the value of individual stocks to decrease as well. Company-specific risk. The risk that a specific company will perform poorly, which can cause its stock price to decrease. Interest rate risk. The risk that interest rates will rise, which can decrease the value of stocks. Volatility risk. The risk that the value of a stock will fluctuate significantly in a short period of time. Rewards. Capital appreciation. The potential for the value of a stock to increase, resulting in a profit for the investor. Dividends. Some companies pay dividends to shareholders, which can provide a steady stream of income. Diversification. Investing in a diverse range of stocks can help to spread risk and increase the chances of earning a return. Long-term investment. Historically, the stock market has been a good long-term investment, with returns averaging around 7% per year. Now you have a basic understanding of how the stock market works and how you can invest in it. Remember, investing in the stock market can be risky, but with the right research and strategy, it can also be a great way to build wealth over time. As always, do your own research and consult a financial advisor before making any investment decisions. As always, thanks for watching. Tune in next time for more interesting facts and stories from the Daily Nerd.